ever wished for an investment opportunity that basically combines the total safety of a regular bank deposit with, the high returns of the stock market?
I mean, when you phrase it like that, it sounds completely made up.
Right. It sounds like a total scam. But today's deep dive is about exactly that. We're looking at something the Reserve Bank of India, the RBI, just announced on June 8th, 2026.
Yeah, and it's a very specific temporary window. It's a special FCNR swap scheme, and they put a hard deadline on it. It's only valid until September 30th, 2026.
Okay, let's unpack this, because to understand how a boring bank deposit can suddenly, act like a high-growth tech stock, we're pulling from some really great research by financial educator Ajit Kumar.
Right, from his channel, Deep Insight with Ajit Kumar.
Exactly. And he's basically decoded this whole alphabet soup of central banking policy into a toolkit for non-resident Indians NRIs who are living abroad. He wants them to avail this beautiful opportunity before the deadline.
Yeah, and to really grasp it, you have to understand the core instrument first. You need to know what an FCNR deposit actually is, and the hidden currency trap that usually stops banks from offering good rates on them.
Right. So FCNR stands for Foreign Currency Non-Resident Bank Deposit.
Right.
Let's say you're an NRI living in London or Chicago, right?
Right.
And you want to keep your savings in your home currency. You deposit your dollars into an Indian bank, and unlike a normal account, it doesn't get converted into rupees. It just stays in dollars.
Exactly. The bank holds it in that foreign currency.
Yeah.
So when it matures in, say, 3 years, you get your principal and your interest back in dollars.
Which is huge.
Yeah.
Because you completely eliminate the risk of the rupee depreciating. Like, you don't have to worry about exchange rates destroying your returns.
You don't. But, I mean, that risk doesn't just vanish into thin air.
Wait, if the bank takes my dollars but operates in a rupee economy, what do they actually do with my money? Like, I was thinking of this earlier. Say I'm a local bakery.
Okay, a bakery. Go on.
And I borrow a bag of really expensive imported flour from you. I use it to bake local bread, sell it for local currency, but I sign a contract promising to give you an identical bag of that imported flour in 3 years, plus a little extra for interest.
Right.
And I have to do that no matter what happens to the global price of flour. That's kind of what the bank is doing, right?
That's a perfect analogy. The bank is taking on a massive price risk. Ajit Kumar uses some great numbers to show this trap. Say the bank takes your $100,000. They convert it to rupees at, let's say, 95 rupees a dollar and lend it out in India.
Okay, so they have rupees floating around in the local economy.
Exactly. But fast forward 3 years, they owe you dollars. What if the dollar has strengthened and now it costs 110 rupees to buy $1?
Oh, wow. They'd be bleeding cash. They'd have to spend way more of their own rupees just to buy back the dollars they owe me.
Right. And banks hate risk. So to prevent this, they buy currency hedging. It's basically a very expensive insurance policy on the global market to lock in the exchange rate.
And I'm guessing that insurance eats right into their profits.
It completely devours them, which means they have no money left to pay you, the depositor, a good interest rate.
So no one bothers depositing their foreign currency, and the whole system just sort of stalls out.
Exactly. Until the RBI stepped in on June 8th.
Right, the swap scheme.
Yeah. What's fascinating here is how they fixed that exact bottleneck. It's a 4-step process. Step 1, the Indian bank gets $1 million from an NRI.
Okay, step 1 is easy.
Step 2, instead of buying that expensive insurance, the bank just hands those dollars straight to the RBI.
Wait, really? Just hands them over?
Yep. And step 3, the RBI gives the commercial bank the exact equivalent in Indian rupees at today's rate. So now the bank can lend locally with zero currency risk.
Because they don't hold the foreign currency anymore. They just outsource the entire problem to the central bank.
Exactly. And step 4, at maturity in 3 years, they just reverse it. The bank gives the rupees back to the RBI, gets the dollars back, and pays the NRI.
So the RBI is basically saying, bring foreign currency into India, and we will handle the exchange protection.
Yeah, they absorb the whole hedging cost, which means banks save a fortune, and suddenly they can afford to offer those much better interest rates to NRIs.
But, why? Why is the RBI doing this? They're not a charity. What's in it for India?
If we connect this to the bigger picture, it's a massive win-win-win. Ajit Kumar points this out perfectly.
Right.
The NRI gets a safe investment with a great foreign currency return. The banks get cheap funds without the hedging nightmare. But for India,
Yeah, what's India's play here?
They get a tidal wave of foreign currency flowing into their forex reserves,
Yeah.
and when global markets get volatile, huge forex reserves are literally a national shield for the rupee.
Ah, so they use those dollars to stabilize their own currency if things go south. It's like a macroeconomic defense mechanism.
Exactly. They are buying economic stability by offering this beautiful opportunity to people living abroad.
Okay, so a 6% return on a super safe bank deposit is great. But earlier we teased something crazy. We were talking about high net worth NRIs turning a 6% return into almost 20%. How is that even mathematically possible?
It's all about financial leverage. And Ajit Kumar breaks the math down brilliantly. You borrow money overseas to invest in this scheme in India.
This one, here's where it gets really interesting, but I want to make sure I understand. It's like buying an expensive apartment using a low interest mortgage, but you rent it out for slightly more than your monthly payment, right? You make profit on the bank's money.
That's exactly it. You capture the spread. So let's say you secure an overseas loan at 4.5% interest. You deposit it in the FCNR scheme getting 6%.
So you're making a 1.5% profit on the spread, which honestly doesn't sound like 20%.
It doesn't until you use leverage. Let's look at his 5x leverage example. You have $1 million. You borrow $5 million against it.
Oh, wow. Okay.
So you deposit $6 million into the FCNR. After 3 years, when you pay back the loan and the 4.5% interest, you're left with a profit that equals an 11.9% compounded annualized return.
Wait, on your original 1 million.
On your original $1 million. And if you do 10x leverage, you borrow $10 million against your $1 million. Deposit $11 million total.
That is a massive sum of money.
Right, but the 1.5% spread on $11 million, that yields a 19.3% compounded annualized return.
That is insane. You're getting equity-like returns from a boring bank deposit. But, I mean, there have to be a catch. Like, 19% returns don't just happen without risk. Leverage is a double-edged sword.
Absolutely. And Ajit Kumar doesn't shy away from the risks. If your overseas loan has a floating interest rate.
Oh, like if global inflation spikes and your borrowing cost jumps to, say, 6.5%.
Then you're losing money every single day because India is only paying you 6%. And your money is locked up for 3 years.
Yikes. Or what if the bank asks for more collateral, like a margin call?
Exactly. Excessive leverage can ruin you if credit suddenly dries up.
And we have to talk about taxes. Because the tax man always cometh.
This raises an important question, yeah. The tax situation is a huge catch. In India, the FCNR interest is completely tax-exempt for NRIs. No tax deducted at source. Fully repatriable.
Okay, that sounds amazing, but
if you live in the US, the UK, Canada, these places tax your worldwide income.
so the IRS doesn't care that India gave you a tax break. They want their cut of that 19% return.
They do. You legally have to declare it locally, which is why professional tax advice is mandatory here. And, it's worth mentioning, Ajit Kumar's channel isn't just about making rich people richer.
Right, I noticed that in the research. He does a lot for regular folks too, right?
He really does. He's made so many videos educating people on the EPS 95 scheme.
What's the EPS 95 scheme?
It's an Indian pension scheme. He's been fighting for pensioners' rights, helping elderly people who are just trying to get a minimum livable pension.
Wow, that's quite a contrast. High-flying 10x leverage on one hand and basic pensioner rights on the other.
It is. But it shows he's really a champion for financial literacy across the board. Whether you're an ultra-wealthy NRI or a pensioner, you need to understand how the system works.
Yeah, critical thinking is key no matter what tax bracket you're in. So, to summarize, this crazy FCNR swap opportunity is closing on September 30th, 2026. The RBI is absorbing the risk, banks are paying high rates, and leverage can turn that into a massive windfall if you know what you're doing.
And if you manage the tax and borrowing risks, yes.
So what does this all mean? I want to leave you, the listener, with something to think about. Just consider how weirdly interconnected global finance is. You have a central bank in India trying to stabilize its national currency, and by doing that, they accidentally create this multi-million-dollar loophole for, like, a software engineer in Silicon Valley or a doctor in London.
It really makes you wonder.
Yeah, it makes you wonder what other hidden gears of the global economy are turning right now, waiting to be discovered. Keep digging, stay curious, and we'll see you on the next deep dive.
Disclaimer. The interest rates, returns, and calculations discussed in this video are for educational and illustrative purposes only. The rates mentioned are based on assumptions and may vary from time to time, from bank to bank, and depending on individual cases. Actual FCNR deposit rates, terms, and benefits should be verified directly with the concerned bank before making any financial decision. This video should not be considered financial advice. Viewers are advised to consult their qualified financial advisor or banking professional before investing or making any financial commitments.
Friends, I hope this video has given you useful information and a better understanding of the topic. If you found this content valuable, please support us by liking this video, sharing it with others, and subscribing to our channel, Deep Insights with Ajit Kumar, DIWA. Don't forget to press the notification bell so you never miss our upcoming videos. On DIWA, we bring you deep insights on important social issues, educational topics, financial awareness, and informative discussions that matter in our daily lives. Your support encourages us to create more meaningful and knowledge-based content. Keep learning, keep thinking, and keep exploring new perspectives with Deep Insights with Ajit Kumar, DIWA. Thank you for watching.